You're holding a stock that hasn't moved in months. Or worse, it's slowly bleeding out. The decision to sell can feel completely paralyzing, especially when you're watching every other part of the market and your friends' crypto portfolios exploding in value while your capital just sits there helplessly. When investors face this stress, almost all of them make the exact same mathematical mistake. They fixate on the price they originally paid. You tell yourself you'll sell as soon as it gets back to break even. But as Warren Buffett points out, the stock doesn't know you own it. It doesn't care if you're down 50% or up a 100. The market is entirely indifferent to your personal feelings. That means your decision to sell can never be a backward-looking reaction to what you lost. It has to be a strictly forward-looking decision about where your money should go next. Before we look at the specific triggers that tell you exactly when to sell, we need to clear up a massive misconception. We are constantly told that the best investors buy great companies and hold them forever. This idea is almost entirely attributed to Warren Buffett. He is frequently quoted stating that his favorite holding period is forever. Taking that quote as literal advice for your own portfolio ignores his reality. Today, Buffett manages an $800 billion conglomerate. He holds subsidiaries forever to maintain personal relationships with their CEOs, not because it yields the highest return. Look back at his partnership letters from the early 1960s, when he was actually building his initial fortune. He explicitly wrote that his bread and butter business was buying undervalued assets and selling them the moment the price corrected. A massive conglomerate is handcuffed by illiquid positions and corporate relationships, but an individual retail investor is agile. You can operate without those constraints and focus entirely on return on investment. Everyday investors must operate like the aggressive, wealth-building Buffett of the 1960s. Holding forever is a luxury you cannot afford. You need strict rules for selling. The first objective trigger for hitting the sell button is simple. You found something mathematically superior. In investing, every single dollar is subject to opportunity cost. If you lock your capital into shares of Company A, those exact same dollars cannot be put to work in Company B. You extract cash from a fair value asset, reallocating it to an undervalued business. But selling triggers taxes and fees, eating into returns. This penalty creates the do-nothing zone. If the new stock is only slightly cheaper, the math won't clear this tax barrier. To make the swap work, the gap has to be massive. Buffett historically sold stocks trading at 3 times their earnings, strictly to buy companies trading at 2 times their earnings. You only sell for opportunity cost when the new asset's upside is definitively large enough to clear those built-in penalties. The second objective trigger for selling is when the underlying economics of your business take a permanent hit. This happens when a company loses its core competitive advantage, its moat. The specific reason you originally bought the stock no longer exists. Look at the airline industry in 2020. Buffett dumped his major airline stakes because global travel demand collapsed. The world had shifted, and the ability for airlines to generate cash in that environment had essentially disappeared. You have to separate these structural breakdowns from temporary macroeconomic dips. Selling a healthy business just because there is scary news on television usually destroys wealth. When Britain voted to leave the EU in 2016, investors holding European companies relying on British trade had to make a decision. Is this a temporary hurdle or a permanent impairment to their supply chain? If the impairment is permanent, you have to get out. Holding on to a broken business out of blind loyalty or waiting for the price to recover to what you paid guarantees capital destruction. Swallowing your pride and taking a paper loss early is mathematically superior to writing a dead business all the way down to zero. The final reason to sell has nothing to do with failing businesses. You sell when a single holding performs so well that it becomes a threat to your portfolio. There is a constant tension in investing. You want to let your winners run to build massive wealth, but you also need to diversify to protect it. Imagine a scenario where a single stock inflates so rapidly that it suddenly makes up 40% of your total available capital. That is exactly what happened to Buffett with American Express in 1967. At that size, you have outsized risk exposure. Your financial stability is tied to a single point of failure. Any regulatory issue or sudden market shock to that one stock will gut your net worth. Buffett trimmed his position down. Taking those profits wasn't a lack of faith in American Express. It was a mechanical requirement to establish a survivable risk baseline. Selling for risk management is a calculated trade-off. You willingly cap your maximum upside to guarantee the long-term survival of your portfolio. To execute these 3 rules effectively, you need a single objective test to strip out your emotions and the memory of the price you paid. Ask yourself this question: if I didn't already own this stock, would I buy it today? If you are an active optimizer, ruthlessly hunt for opportunity cost. Just make sure the gap clears the tax friction of the do-nothing zone. If you prefer a buy-and-hold strategy, abandon misplaced loyalty. Immediately cut losers whose underlying moats have permanently deteriorated. And if you accidentally hit a home run, give yourself permission to take profits. Trim the bloated winner before it threatens your diversification. When you do this, you stop managing a list of memories and start managing a pool of capital. Your portfolio moves away from emotional anchoring and reflects the current reality of the market. Successful selling is about recognizing that your past mistakes don't have to dictate your future returns. It's the process of looking at your holdings today and deciding they are still the best place for your money to be.